Hello everyone, welcome back to my channel. So in this video we are going to discuss the relationship between the delta and the vega. If you recall the last three videos that we did, we discussed the relationships between the delta, the theta and the gamma. And in all of those we established that the implied volatility was always the same. And the effect of the implied volatility in an option is measured by the Vega. And the Vega, the definition for those who don't know, the Vega simply measures by how much an option premium or the option price will change if the implied volatility changes by 1%, either up or down. And what this means is that the volatility, the implied volatility increases, an option will also increase in price because with a higher implied volatility, the range of possible outcomes of an option is also wider, is larger. But what happens is that you don't care about the downside of these or the downside part of these outcomes, because when you buy an option, a call or a put, your downside is always capped. Your maximum loss is the price that you paid for the option, but your upside is either limitless or equal to the value of the underlying in the case of a put. So because you have this disproportionate upside relative to your very mitigated downside, it's good to have a wider range of outcomes rather than a narrower one. And so that's why the bigger the implied volatility, the higher the cost of an option. And so what we are going to show here is that for different levels of price, for an option which is out of the money, for an option which is at the money and in the money, we are going to see what's going to happen to the relationship between the Vega and the delta for different levels of implied volatility. We are going to use 10%, 20%, 50%, and 20 and 100% of implied volatility to show how this relationship changes when the implied volatility changes, because the implied volatility, and in this case by extension the Vega, not only changes the price of an option and how much does it change, but also changes the entire profile of the delta curve. And this is something that we are going to see. The relationship is not linear, but is something that you must keep in mind if you want to trade options at a more advanced level. And I'm also going to show one of the things that sometimes is a bit more misunderstood, which is when you have a stock that is going to release its earnings soon, many traders sometimes buy an option, all right, because they have a perception that either the stock is going to go up or is going to go down, and for this effect they buy an option, and many times they lose money even when they get the direction right. They buy an option because they think the stock will go up, but even so they lose money. And the same thing happens when they think the stock will go down and they buy a put for that purpose. And so I'm going to show why this happens and what are the underlying motives of this outcome. And the last thing that I need also to emphasize is that, unlike the previous videos in which we used a trading platform to show the relationships between Greeks, because the implied volatility is something that we simply cannot manipulate. We can manipulate the time to maturity, we can manipulate the strikes, but we cannot manipulate the implied volatility of an option. We are going to use an options calculator to show how these dynamics change as we move or as we change the different variables that are related to these concepts. And yeah, this is what I'm going to show you. And so let's go. Alright, so here we are. This is our calculator that we are going to use here. And let's start here by first setting up what will be the time to expiration. This will be a fixed variable, and we are going to use 30 days out. Why is that? Because for the purpose of showing the relationship between the Vega and the Delta, we want to isolate as much as possible the effect of the Vega. And so we need to use a relatively longer maturity, because if you use a too short of a maturity, like for example 10 days out or 5 days out, the effect of the gamma and the theta will be much bigger, and that will distort the result that we'll be getting. And so in order to get these effects of the gamma and the theta minimized as much as possible, we need to use a relatively longer maturity, and for 30 days out is relatively enough, because we also want the raw effect, the effect of the raw, not to be present or to be minimized. We are going to use a risk-free rate of 0, and we're not going to use any dividend yield because it doesn't really matter at this point. And let's start here also by assuming that the strike price will be 100, because this will be a fixed variable in our analysis. And let's use here first and foremost a volatility of 10%. 10% is a very low volatility. This is the volatility that you would expect, for example, from an ETF tracking a very large index, for example, the S&P 500, at a moment in time in which everything is calm, there are no significant economic data coming up, no earnings of significant companies coming up as well. So everything is as peaceful as it can possibly be. And let's start here by using out of the money option. All right, so we are going to use here the spot price of 80. Keep in mind, we are using call options here, even though the relationship between the delta and the Vega are exactly the same regardless of a call option and a put. All right, and so I'm going to show this how this works for the call option, but the values for the put option will be the same, except for the fact that the delta will be negative instead of positive, but the numbers will be exactly the same. And so using this out of the money call option, all right, and this is very much out of the money, it's 20% below the strike. You can see here that the delta is very, very close to 0, as is the Vega. And why is that? Because as you can see here in the delta curve, because the option is so much out of the money, and because we are using a very low volatility, even though we are 30 days out, this option is extremely likely to remain out of the money, because it's 20% out of the strike price, and the volatility of this option of the stock, of the underlying stock, is very low. So chances are it will remain that way, and so the Greeks, as you can see here, are almost meaningless. The option is as good as dead at this point. All right. And now, if we are going to simulate that the option is at the money, right? This is an interesting case, because now the delta is very close to 50 or to 0.5, whatever you want to call it, and the Vega now is now significant. At this moment in time, the option can go either way, can become in the money or out of the money very easily, and so that is the reason why, as we explained before, the gamma is at its highest, all right, but the Vega also is significant, all right, because any change in the volatility at this point in time can make the stock go in the money or out of the money, the option go in the money or out of the money. So the value of the Vega, as you see here, it's the change in the option premium when the volatility increases by or changes by 1%. So you can see this is significant. And now, if we are going to use a very much in the money option, the option is 20% above the strike, you see here that the opposite happens as relative to out of the money. The delta is 1, the Vega is nearly 0, and so this is the behavior that you would expect from the stock itself. The option is very much in the money, and so it will behave just like the stock. Even though we are 30 days out, again, because of the very low volatility of the underlying asset, it's very, very, very likely that the option will remain in the money when the time expires. And so that's why it will be like this. The option will remain like this. Now, as you can see, also, if I increase marginally so, and I'm going to go back here to the out of the money option, and let's go to the example of let's crank it up the volatility a little bit more, you'll see that the delta curve will start to change and it's going to become a little bit flatter. And I want you to pay attention to what's happened to the curve here and what's going to happen both to the delta and the theta as I increase the volatility progressively. So as you see, and that we are going to crank it up progressively up to 20%, all right? And so you see here now that a volatility of 20%, by the way, is a volatility of a relatively safe and stable stock, all right? Individual stock, I should say. And it's also comparable to the volatility of, for example, the IWM or even the Qs when there's a bit more volatility. And so this is probably most of the volatility of most of the stocks that you would invest with relatively relatively lower risk stocks, all right? And so you saw that the delta went from basically 0, all right, to 0.001. Again, a meaningless, almost meaningless increase in the delta, but now the option is not as dead as it was before, and also the Vega also increased. And why is that? Because now, even though we are 20% out of the money, the higher volatility means that the option is not as dead, and so there is an increased volatility that the option will transition from being out of the money to potentially being in the money. And so the option reflects this increased probability by increasing the delta a little bit more and also increasing the Vega. And now, if we are going to change here to, let's do this progressively. I think it's easier for you to understand. As we now go from being out of the money and the stock starts to rise in value and reaches at the money, you saw that the delta started to increase, all right? And now it's very close again because it's at the money, it's very close to 0.5, but a bit more sensitive to the changes in the price than before because of the volatility. And also the Vega is the same as it was before, all right? And it's the equivalent. You cannot see many more decimal places here, but now you can see that the Vega is slightly smaller, all right? As the volatility increases, the value of the Vega when at the money will become relatively smaller. And I'm going to show here, you'll see that the Vega will start to reduce, all right? You see that the Vega start to reduce slightly so, but let's go back here to the 20. So, but it's meaningless. The Vega continues to be relevant at this point in time, and that is why we see that the changes in the volatility still continue to affect the option price, as you were able to see right here, right? And so now if we move 20% above, all right, and we are now in the money, again, the price is 20%. As you saw before, when it was 10, it was a parity, the option is trading at parity, so it costs 20 to capture a $20 profit, so it's at parity. But at this point in time, it has a little bit more, it costs a little bit more. And why is that? The reason is because the option can still appreciate a bit further to increase the maximum, to get to the maximum price. All right, and so the delta is not exactly 1, so the option, even being 20% in the money, is not behaving exactly like the stock. All right, and why is that? Because with the increased volatility, there's an increased chance that the price will reverse, and option may end up out of the money. All right, and so you see that the Vega is here still matters more than when it was 10%. All right, here it was basically 0, but now with an increased volatility, the Vega still has some effect. And why is that? Because volatility will still play a role in potentially taking this option away from in the money. And so that's why we have a slightly smaller delta and a slightly higher Vega. And as you see here now, as we are going to increase the volatility, you start to see that, of course, the price will increase because there is still value in the stock. The stock, there is still value in the option. Why is that? Because at this point in time, with 20%, the option can still gain more value because it not reached the 1 in the delta. It's not at its peak value. All right, and so that's why the Vega will make more and more of room in the price. As you see it in here, it will have a larger and larger influence in the price in order to either bring the stock even more in the money, so that the delta will be a 1, or potentially throwing it back into out of the money. All right, and so let's go back here to 20. Now let's go back to 80 out of the money, but this time we are going to crank it up to 50%. All right, and you will see what's going to happen to here, to the curve. The curve will become flatter, the delta will increase because being 20% out of the money with 50% volatility, the option will be far from dead. And the Vega will also increase in kind, again, because it will be with 50% volatility, the volatility will have a bigger force. Let's just consider it like a spring. All right, it will have a stronger spring to eventually take the option from this point where it is, which is 20% out of the money. And so as we continue to crank it up, the volatility, you see that we are 20% out of the money, but the Vega continues to increase, because the effect of the Vega means that as we crank it up the volatility, the spring that will take the option from out of the money to potential in the money is stronger. And so you see that the option at this point, it's 20% out of the money, but it's very far from that. Having here a change in the price, you see here, there is the price changes, the price of the option changes even with slight changes in the stock. Whereas if you recall, with 10% here, it didn't move. We need to go, the stock would need to appreciate much more for the option to get back to life. And so that is why with an increased volatility, this is no longer the case. The option is very much alive. And you see here that now with every dollar that the price moves, all right, the increase will be almost 7 cents. All right, now this is also a bit more because of all the other effects that we have in here. All right, but you see here that the effect of the price of the changes in price makes the stock make the option move. Now, if we go back to the at the money, you'll notice that the delta will increase. All right, it will increase towards 50, but will continue to exceed the previous delta of at the money, so it will be it will be further above the 0.5 and something that we had with lower volatilities, and the Vega will also increase. So you see here that the option will become more and more and more alive, will become more springy, all right, because of the force of the delta of the Vega, and you now can see that the delta here, right, it's 52.86. You recall that here it was very much closer to 0.5, all right, but with a volatility of 50%, this moves the delta upwards. And what this means is that any change here in the price makes more of a difference in the price of the option than it had with a lower volatility, all right? And because this is also much more likely to happen, these changes in the price, when the volatility is higher. That is why the delta also changes. And as you can see here, the Vega is very, very slightly lower. But why is that? Because the delta gained more of an effect in the call option price. This reduction in the effect of the Vega is more than offset by the effect of the delta. And now, if we move 20% above, you'll see that the delta will be lower than it was before, all right, with 20% volatility and 10%. You see that the Vega will be slightly higher, all right? You see here, for example, now with 10%, now with 20%, and now with 50%. The Vega is higher, and why is that? Because this valuation of the option still has not reached its maximum in terms of the delta. The delta still can continue to increase. The option is not behaving like a stock yet, and so it needs to be, for example, 130. 130 is not even the case, but probably 150. It's not even the case even. And if we put here 170, so for example, for a price of 180, all right, now we reach what he wanted. We need a price of, for example, 80% above in order for the stock for the option to behave like a stock and the Vega to be reduced basically to zero. And what this means is that you need, with 30 days out, you need the option to be in the money by 80%, or you need the stock to be 80% above the strike, so the option is 80% at the money, so that it can offset the volatility of 50%. With this much appreciation above the strike, the market and the option, this volatility is no longer enough to counter, or is no longer seen as likely to counter this the fact that the option is in the money, all right? And so if we now crank it up, the volatility further, you'll start to see that at this point, with the volatility of 54%, from this point onwards, even being 80% above the strike, the is no longer enough to be completely assured that the option will remain in the money, all right? That is also the reason why, if you see some textbooks, if you see other videos online, you will see that many traders use the delta as a probability of being in the money, the option ending in the money. At this point in time, for example, if we use here a 50% with a delta of 1, that means that for sure this option has 100% probability of finishing in the money. But as we crank it up, the volatility at this point in time is no longer 100%. It is less. And as we crank it up, the volatility, the Vega continues to increase. And so at this point in time, with 100% volatility, we are talking about those very small companies, those highly volatile tech companies, and so, or for example, ETFs with leverage. In this situation, you see here that the curve is still a curve, but no longer as much as it was. The delta is even higher at being at the money. Because the spring is so high, so large, and so strong that the Vega, even though the Vega is no longer as high as it was before, it's still very significant. And if we go back and we used 20% out of the money, 20% out of the money option, you see that even with an increase in price of 1, the option still moves a lot because of this 100% in volatility. And so this is the relationship between the delta and the Vega. Normally, under normal circumstances, you see that as we go from out of the money to at the money, the delta and the Vega increase, all right, and it reaches its peak of being at the money, all right. So I'm going to, you will be able to see this relationship as I go along. You see that the Vega continues to increase, all right, and then as we reach at the money, all right, it will start then to come down as we go past at the money. It's not exactly at the point of being at the money that the Vega reaches its peak. You see here it continues to increase, but then at around 104 or 105 it goes down, because as the price continues to increase, the delta continues to increase, but the Vega then comes down. In that sense, it behaves a bit like the gamma, because the gamma also reaches its highest value around the ATM value, the ATM price. Now, if you use, for example, again the 10%, and we go again to an out of the money option, you will see here that, of course, it still moves, but moves very slowly. The progress is very small, all right. But you see here that it reaches this value, all right, and then it no longer increases. So in that sense, you can say that the Vega, when the volatility is very low, it reaches its peak exactly at the money. When the volatility is very high, you see that the peak of the Vega is reached when the stock is a little bit in the money, so it passes beyond the point of ATM, and in that case, it also behaves a bit like the gamma, because the gamma does not peak also under all conditions exactly at ATM. And now what I wanted to show, and this is something that I think is very interesting, and sometimes it gets a bit misunderstood, is the following. Let's use here 10% volatility to start with. So, as you know, many times, and you probably notice if you already traded, you will notice that a given stock, when its earnings is about to come, you will see, for example, this with tech stocks. With tech stocks, especially the Magnificent Sevens, because they are very much capable of moving the market entirely on their own. When an earnings announcement is coming up, you'll see that the volatility, the implied volatility of these stocks are very high. because the traders are buying a lot of options, either calls or puts, depending on what they are expecting that it will happen. But the volatility is very high. Let's just assume, for example, that a stock like Nvidia, which I can't remember what is the volatility that they have, but they they may have, for example, let's just assume a volatility of 60% under normal circumstances, so they would have, for example, a volatility of 100. Let's just assume this way. This is, of course, before earnings. And now, given this volatility, you think, all right, the volatility means that the traders or the market are expecting a big move. And I think, my opinion, is that the stock will go up. So it makes sense that I will use a call option. I will buy a call option to to take advantage of my conviction that the stock will go up. The earnings will come good, and the guidance will also be very good. It will exceed expectations. So I expect that the stock will go up, and that's why I'm going to buy a call option. Now, many times, and that is one of the reasons why sometimes traders lose money, is that you have the situation, but then the earnings are announced, and then what you'll see, you keep in mind, you paid 11.39 for the stock, so 11.4 give or take, and what's going to happen is that the earnings were good, not a blowout, they were still good, but then this happens. Keep in mind this value. What happens is that the stock rose by, let's just say, 3%, all right? But then the volatility came down to 40. You see what happened? So in this case, the option, like I said, the option, the Nvidia stock usually can, let's just assume it was 60 under normal conditions and it was 100 before the earnings. So what happened here is that I was right. The stock moved up. The earnings were good, not a blowout, but they were still good. But then this happened. I bought the stock or the option at 13, and now I'm in a situation in which I was right, and yet my option now is less valuable. And even if we use, for example, here a 5% appreciation, which under normal circumstances is quite good, a 5% reaction post earnings is usually a very strong gain. But what happened is that because of the fall of volatility, because the uncertainty is gone, the earnings are out, the traders are no longer in need to trade options because the results of the earnings are already known. What basically happened is that it's a phenomenon that is usually called a volatility crush. Because the volatility tanked, the option lost value, as it's normal, it was expected, but then the gain that we had was not enough to counteract the loss in volatility. In our case, because we bought the option at $13.40, we would need a move of around 11%, so 10% would still be a loss. It would really need a move of at least, let's just put here like this or like this. Yeah, this is more or less the number. So we would need an increase in price of 10.2% or more in order to offset the crush in the volatility. And so that is why you see that many traders who try to trade options on earnings, they get the direction right, but still they lose money because the loss in the volatility, which is reflected in the option price by the Vega, is not sufficiently offset by the increase in the price that is influenced by the delta. All right, and so this is a relationship between the delta and the vega that it's very important to understand. And if you see that an option is being very inflated in terms of volatility because of earnings are coming up, or a very important reading of inflation is coming up for some reason, if you see that the stock, the option is very inflated in terms of volatility, the volatility, for example, for the option has doubled or even went beyond that, which is unusual, but you never know. Be mindful that when the option comes back to normal after earnings, the bigger is the difference. All right, the bigger was the increase in volatility, the more you will have to, the bigger the move you will need in the right direction to offset this decrease or this drop in volatility. And that is why sometimes it's good to bet on this move if the increase in volatility is not that big. But then the other way around, the other face or the other side of the coin is that if the volatility hardly increased ahead of earnings, that means that nobody was expecting a big move, and it was not that important. And so chances are the move will never be that big, and so you will not make money anyway. But that's why buying options to bet on a move for the earnings, post earnings, is sometimes a very dangerous proposition, because it can happen that the stock will move in the direction that you want, but not in the magnitude that you expect, and so in that case you will lose money. But still, the last point I want to make is that, as you see here, the values of the delta and the vega are identical, because you see here the reverse or the mirror image of 0.5286, it's 47.14. All right, this is the difference between if you add this number, all right, if you add this number to this number, but you take out this minus signal, it will always account to 1. All right, and you see that the vega does not change. So that is why the call and the put, the relation between the call and the put, the relationship between the vega and the delta are the same. The only difference is that, of course, if you are out of the money in a put, in a call, that means that you are in the money at a put, and vice versa. And you see that these numbers are always amount to 1, the call and the put. Of course, if you do not consider the negative, the minus value on the put, because the delta is always negative for puts. And so yeah, this was the most important insights for the relationship between the delta and the vega. And so let's just summarize what we have just witnessed. In a very low volatility environment, what happens is that options which are out of the money, they have a very high likelihood that it will remain that way. The volatility, it will not be enough to bring them back into the money. And so most of the options which are out of the money are just considered dead. They have no delta, the vega is 0, all the Greeks are 0 because the option is dead. But if they are in the money, it's also very likely that they will remain in the money. And so the delta will be very much 1, the vega will be very much 0, all the other Greeks will be 0, and these are the same Greeks that a stock would have, because a stock would have a delta of 1 and all the other Greeks will be 0. And so across or along the delta curve, there are many options which are dead and many options which behave like stocks. But as we increase the implied volatility from 10% to 20%, 50%, 100%, there will be less and less and less out of the money options which will be dead, and on the other side of the coin, there will be fewer and fewer and fewer options that are in the money but behave like stocks. So less options behaving like stocks and less options that are completely dead. The curve, the delta curve will be flatter, all right? And that means that the implied volatility has the power to bring an option which is out of the money back into the money and vice versa. An option very much in the money can reverse and be out of the money by maturity. The spring, as I mentioned, of the implied volatility is much stronger to take an option from where it is to another state and vice versa. And so, the main takeaway that we can take from this is that the implied volatility, and by extension the Vega, has the power not only to change the delta, the directional exposure of the stock, but it can completely change the dynamics between the price of an option and the strike price. And even just by changing the implied volatility of an option, even if the stock does not change, the profile of outcomes of an option can change. So nothing happens, the stock does not move, but just because implied volatility changed, your profile of outcomes of an option can be completely different. And so it's a very powerful Greek, and it's one that every options trader should keep in mind to make sure that it does not get caught out in situations where he's playing for a specific outcome, but because of a change in volatility, it turns completely upside down, and an expectation of a winning trade can become a losing trade. And so, yeah, that's what I wanted to show in this video. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we'll reconvene on the next video to show the relationship between the Vega and the Theta. And I'll see you there.